Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today we have our Frac Spread show, so we're going to cover what's happening with the Frac Spread count, where do we see things progressing throughout the remainder of this quarter really, and then also going to look at what is happening on the production side, and then going a bit further and talking a bit more about inflation and some of the data sets that came out, and then obviously we'll do the deeper dive next week in the econ show. So the primary vision frac spread count was up by 10. So we went from 244 to 254, and they were where you would expect them to be in terms of where we had come down, Appalachia, the Permian, and then in the another big jump in the Western Gulf. So when you look at just the Permian, there's been some pushback or some back and forth as to where the Permian was from November to December, and it was really flat when you look at where November into December was, and it's still strong, as we've been saying, that the seasonal drop, as we talked about in December, really didn't come into the Permian. There was a little bit in that last week, but as you would expect, because it is Christmas into New Year's, but then the Permian is right back to where it was. And if you compare that to historics, we're still either at or above where we've been over the last 5 years. So the Permian still continues to be the growth driver. The bigger issue now going forward will be what happens next. Like, where is the next, that next push in terms of activity? And it's not going to be, no one's out there building new capacity. There are some e-fracs that we've talked about and we have a report on. But when you look at the new horsepower coming to market, it's going to be refurbished, it's going to be rebuilt. And that's some of the things that we're going to look at right now. So as we've been talking about in the econ show for as long as we can remember at this point, there are supply chain issues, and obviously the supply chain caught up a little bit. I'm not saying that we're back to normal, but there was a little bit of a softening in terms of some things speeding up. So we did get some of these deliveries of pieces of equipment, of parts. So that will make things a little bit easier in the near term. But it's when you look at what's happening in China again, when you look at what's happening in the supply chain, things are still stretched. So we're still going to have shortfalls. We're still going to have some sluggishness, but we do believe that you'll get to that 270 spreads really by either next week or the week after, just based on how quickly things are going to bounce back. This is going to get right back to where we were. But then the next incremental 25, to that 300, that's going to be a little bit slower. That's something where we don't really think we're going to get to that 300 to the end of Feb, but realistically, more likely that beginning of March. And then the push to 325 is going to be, where are the spreads? For an example, if there's 5 available spreads in Appalachia and there's 0 available spreads in the Permian, are you going to spend the money to move the 5 from Appalachia to Permian, or are you just going to leave them there? So even though theoretically there's enough spreads in the market, they're in the wrong locations. So again, these are some of those things that we have to look at, because just because they're available doesn't mean that they can actually go to work. So because those are some of the key things that we need to look at, and obviously we'll keep you abreast on it, on the insights, on the show, just to look at, where do we see this growth, but it will be driven a large part by Texas, New Mexico, and Louisiana, and then and Oklahoma, but that's something that we've talked about separately. So now when we look at the rig count, the rig counts obviously had a nice jump. The oil was up 11, gas was up 2. But when you look at and I think more importantly, when we look at the different backdrops, it's that horizontal. So horizontal was up 9. So when you look at the timing, because remember, the frac spreads came down in December on a national level, rig count didn't. And now rig count is reaccelerating. And now frac spreads are also catching up, but there's still that disconnect in terms of positioning, which is just building that backlog, building that ability over that time period of DUC inventory. Because remember, we've worked through a lot of that inventory and it has to be replaced. We want to be able to essentially have a continuous movement which is why we think that you're going to see the rig counts continue to go up through Q1 into Q2, and then you're going to get a bigger run in frac spread counts in really Q2, but more Q3, and that will get us that push to about that 12.2, 12.3 million barrels a day exit rate that we're really starting to see. And then in the first segment of the EIA show yet on Wednesday, we talked about CapEx. The CapEx is increasing, but when we look at frac spreads and we talk about refurbishing, repairs and equipment, you still need the labor. And labor prices were very high last year, and we don't see that changing, especially on the oil field service side, because there is a lot of work to be done, and it's not easy, and it's a grind, which is why you're going to see those prices continue to be elevated. Now, when we look at where some of that demand is, because one of the problems that we're coming into, after with WTI Cushing now at $84, is the cost. And when you look at what Asia's doing, where China's buying, we're seeing a big slowdown in the purchasing of U.S. crude. Now, Europe is still buying U.S. crude at a fairly steady clip versus the last 4 months. But Asia's really been that difference, and we don't see them buying at this level. Instead, as we said in the EIA show segment 3, you're seeing Asia buy a bit more aggressively from West Africa and starting to pick up some of those purchases from out of Eastern Russia. So those are some key pieces where the U.S. is going to start to see some of those builds on Pad 3 accelerate. And just also on the product side, European shipments of clean oil products to the Americas have slowed down early January following a jump in December, but that's starting to close that gap, as we'll show in a second. And a lot of it is also, we're starting to see an increase in diesel exports given the shortfalls in Pad 1 versus some of the excess in Europe. So just looking at some of the key pieces, as we said last in the EIA show, we expected to see some decent builds in gasoline and gas oil in Europe. We got it. We got them in both. Gas oil still at the low end. Gasoline starting to creep up, which is why we will see some of that additional product come across to Pad 1 as well as into Latin America. And then fuel oil also accelerated. And if you remember from segment 3 of the EIA show, we're starting to see high sulfur fuel oil get pulled into the market again. And that's on the power gen side, just because LNG prices are higher, natural gas prices are higher. So you are seeing some HSFO getting moved in. And a lot of that, again, that ARB is opened back up, sending some from Europe into the floating market. On the Singapore side, we got the builds that we were expecting, especially in light distillate and resid, but we didn't get it in middle distillate. Middle distillate continues to be the bullish spot, the bright spot. So it's going to be interesting to see what happens with China, because they're starting to slate some more, product for export, and same for India. It should show up on the middle distillate side in Singapore, but right now, still a very bullish backdrop. Now, speaking of some of these crude flows, Angola crude for February loading is selling faster than it did a month ago, which a month ago was still slow, but again, still a positive to see. As we talked about in segment 3 of the EIA show, you're starting to see that acceleration. You're starting to see some of those cargoes move out, and they had more than enough floating storage to accelerate that. Congo is now sold out for February, so that's caught up, and Gabon has added over $1 more than dated Brent, which again is an increase. Nigeria is still looking to sell 15 to 20 cargoes in February. Things accelerated, but now they've slowed down a bit as Libya's come back online. CPC has increased the amount of loadings for February and for February, with the more coming in March. So Nigeria is still starting to be a little sluggish, but Angola and Gabon and Congo have increased or gotten a bit more normal, indicating more going into Asia. Now, when you look at other European backdrops, so European refiners are sending more diesel, and right now there's two tankers that should bring about 1 million barrels combined of ultra low sulfur diesel. So that's going to be something to watch on the disty side coming in, which makes sense because that has to also be used for heating oil. So this is going to be an interesting backdrop going into the next few months. So now China's supertanker crude imports, as we were saying, essentially from October, you typically have China as a big buyer in November, and then they really go away in December. Sometimes that can bleed into the first week of December. but then they really slow down, and then they pick back up in the January into early February, and then they slow back down. So this is what we're seeing. So what's showing up is coming down. They're now back out there buying. So that means that we're going to get that pick back up, and we should go back above that 5-year average, just based on what they've purchased, things going from storage into transit. So, and just to give you an idea of where is this going, well, 19 tankers carrying about 15 million barrels is leaving the U.S. to go to Europe, but which is an average of about 1 million barrels a day. But right now, we're just not seeing any real buying from Asia because they already have a record amount of floating storage sitting there. Things are slowing down in China. You have Lunar New Year right around the corner, which is February 1st to, I believe it's the 14th or 15th, in terms of, just where they're going to see some spike in terms of traveling. But with COVID, do they have restrictions on travel outright, or do they make it really hard based on timing of getting tested and then traveling? Similar to what we saw in both 2020 and 2021, but more so 2021 when we're looking at some of those backdrops. But we'll talk a bit more on China in a moment. So now when we look at food prices, so global food prices hit the highest since 2011. And if you remember, Arab Spring is right in 2011. So this is something to watch. We do believe that there will be a continuous level, but it's just going to bump around here. We don't see another surge up. It's just a matter of kind of hanging around these prices. We have, as we said last week, this past Econ show in segment 1, soybeans are being taken way down in Latin America. Especially Brazil just reduced it. Argentina just reduced it. So you're starting to see additional pressures on the volume yield side, but you are getting some reprieve from fertilizers. So when you zoom out on this, fertilizer is still very expensive. You've had a lot of buying. This is typically kind of a slow period for buying. So it's not crazy to see some of these drops, but we'll talk more about seasonality in next week's Econ show. Now, looking at where things are, and the reason why we talk about food and we talk about where crude is right now is obviously inflation. So when we look at retail sales, if you remember what we said, we thought September was going to be a down month on retail sales. We thought October was going to be gangbusters, and then we thought November, December were going to be very weak. Instead, we got September very strong, October very strong, right in line with where we were. And then we had a really ugly November, and now we had a very ugly December. And we think that continues into January and February, just given where the consumer sits. So just high level retail sales month over month was expected to be down 0.1. Instead, it was down 1.9%. Then you had all of November that was revised lower. So again, that pressure coming down. Retail sales control group was expected to be 0, so no growth. Instead, we had negative 3.1%. Just give you an idea of that movement down. And there's two pieces to this. One, a lot of people pulled forward their spending, as we talked about with that fiscal stimulus. People tried to get ahead of supply chain and all those pieces. But there was also inflation. Is it going to be there? Is it available? So now as we go forward, wages haven't rallied or I shouldn't say haven't moved in the same as aggressively as inflation. So this is inflation really starting to bite. Now import prices are down slightly, but when you take away petroleum, they were still up. And if you remember, we said that the rate of change of inflation was going to slow in December and then potentially go negative slightly in January and February. And this is what we're seeing now play out in the import-export side. Industrial production was expected to be up 0.2%. Instead, it was down a negative 0.1%, still kind of balancing out. And then if you look at University of Michigan, all sentiment has gotten much, much weaker. Expected to be at 70, came in at 68.8. And then on the expectations going forward was expected at 67, already very low. And instead it came in at 65.9 as the expectations of inflation approaches again 5%. So when you look at the inflation pain, and this is, even though we thought inflation was going to ebb a bit in December, now that we have crude prices where they are, and that then means where gasoline prices are, we've seen gasoline prices accelerate, but more importantly, diesel prices accelerating, because that's going to hit heating oils specifically, as well as just moving things through the supply chain, increasing that underlying cost, weighing more on consumers. And this just gives you an idea of consumer sentiment fell in early January as inflation Omicron fears mounted, second lowest in a decade. Just to give you an idea, it's now below the low from March 2020 to give you an idea of how people feel. And it's when you look at the expected change in inflation during the next 5 to 10 years continues to accelerate. Now, we've beaten to death in flexible versus sticky, but flexible inflation surged 17.9% year over year as of December, now beyond 1980's peak of 16.7%. And now sticky inflation is running at 3.7% annual, but look at that rate. Look at that rate of change. Look at that line. It's being pulled up, and now we see flexible inflation, kind of petering out a bit, slowing down. Rate of change is hanging up here, which again is going to continue to pull that stickiness higher. Now, and the reason why we say that is the spread between CPI and PPI bounced slightly through December, but remains deeply negative at negative 5.1%, which it provides, I think, some of that juice for what we're talking about. Wages need to catch up. We have more pressure coming through on the rent side, as we broke down in this past econ show, and here it is playing out again. Now, when we look at the wage tracker, the lowest earning quartile continues to go up. The highest earning quartile kind of flatlining here, but really still not keeping pace. So look at how much this is accelerated, and it's still not keeping pace with inflation. So as inflation starts to slow, as supply chains catch up a bit, though there's going to be a huge problem with that given where the Chinese disruptions are coming in, you're going to start to see a little bit of wage growth kind of catch up, and you should see real wages get closer to where the inflation rate is. Individuals in the lowest earning quartile continue to have very strong wage growth relative to high earners. 5.4% year over year is the fastest rate since March of 2002, but it's still not enough to cover inflation and other costs. So that's where we have to, which is why inflation is now becoming such a concern, especially when you think on the sticky side and where the and how living expenses will be. And now when you look at retail sales much weaker in December, coming in at negative 1.9% versus negative 10 basis points. So you're just getting an idea of how things are rolling over a bit, but this isn't even adjusted for inflation. So if you adjust this for inflation, it's even lower when you think about not only, because this is a nominal dollar amount, so people were spending less, but then when you look at where the cost of goods are and then the volume of goods, that's where we always talk about value versus volume. Volume continues to fall. And then this is obviously leading into the consumer sentiment issue. When you look at how that is moving down, we are now below where we were at the lowest point of COVID. Industrial production is still continuing to creep higher, a little bit weaker in December, but again, trying to kind of leveling off a bit, which is what the regional Fed data had indicated and what we talked about at the beginning of January, end of December. So now looking at China, when you look at exports came in slightly better. Expectations were for 20%. They came in at 20.9%. But imports were down. So imports were expected to be at 27.8%. They came in at 19.5%. This is the pressure we've been talking about because imports are that leading indicator. Exports, they're still trying to push things out, but you're seeing it roll back. And also remember, volume versus value. This is on a nominal basis. So the value of the products are still going up, but the volume is shrinking. Now this is, layer on all of the issues at the port level, moving things through the system. So you're getting an idea of kind of where some of that pressure is and why we see that additional slowdown in terms of how things close out in December and so far how things are beginning in China in January. And this just gives you an idea of kind of where things sit. So you can see exports are fairly flat, starting to roll a bit, but the headwinds are going to be in the import side because you're starting to see, again, imports slowing down. Local consumption continues to be a problem. And this is, I think, an interesting chart because you look at the service slump. So this is pulling out from the PMI data. When you look, this is not a COVID issue. Since 2018, you had service sector hiring has been in contraction. So this isn't COVID related. This is since 2018. So this is pre-COVID, because remember, in 2018, from 2016 to 2018, China had an insane amount of stimulus come through. And then they started to walk that back, and then they got rid of it most of pretty much all of 2019. And here you can see it playing out. The unemployment, you have to pay these people. Again, all of these pressure points continue to show to a very sluggish internal consumer, which is going to make it very difficult to achieve the dual circulation strategy, common prosperity. We're just not seeing a whole lot of buying in China. So that's the quick roundup. If you have any questions, again, you can find us in the comment section. I think I've caught up with everybody's questions, or you can find me on Twitter. And again, we also appreciate your support. Please like, share, subscribe, share this with anyone you think would benefit, because we do need to help in growing and expanding this and making it bigger than it currently is. So we hope you have a great weekend. And a great long weekend, right? It's Martin Luther King weekend. So hopefully you have something fun planned, maybe going skiing. So thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.